There are so many ways and factors to consider when investing in real estate. So how do we simplify the real estate investment process? Well, if you watched my last video, part 1 on how to invest in real estate, you now have a good understanding of the 2 biggest hurdles blocking people from investing in real estate, and are now ready for part 2. Designing an investment plan that meets your unique set of needs to reach your goals. It's never a one-size-fits-all approach. Now, this next step is where most investors get a little overwhelmed and lost in analysis paralysis. The what should you invest in to help you on your path to more freedom, flexibility, while creating generational wealth through investing in real estate. So to start, let's break this down into a digestible and relatively quick exercise. Feel free to write out these questions to help you think through getting started with your next real estate investment property. Note, there's not a right or a wrong answer. It's about what best fits your lifestyle and your goals. So, question number 1. Do you want to live in the property or not? Well, the benefit to living in an investment property is that there's a lower cost of entry. Typically, the goal of living in an investment property is to have your tenants pay for your living expenses and to keep more money in your bank and less in the property itself. If you're not living in the property, the cost to acquire a property is a little bit, it's more expensive. Depending on the lender, the cash out of your pocket is typically around 20% of the purchase price, but the biggest benefit is cash flow and better tax optimization strategies, which most live-in investments don't produce. Question number 2. Do you want to acquire a condo, a townhome, a single-family home, a multifamily? I know there's a bunch of other options, but let's just focus on the top 4 for right now. So with condos and townhomes, there's generally a lower cost of entry, but there's also a lot of rules you need to follow with regard to renting your property to tenants. They also typically don't approve short-term rentals like Airbnb. You also want to have a little bit more cash reserve set aside if it's an older condo or townhome, as there could be an assessment lingering in the future. Single-family homes generally have the longest term tenants, meaning tenants are more likely to renew their annual lease in a single-family home more so than any other type of property. They also tend to appreciate in value faster and higher than other types of property. And in terms of cash flow, they generally tend to be in the middle, so not the lowest, but also not the highest producing either. Some of the challenges with single-family homes is when your tenant leaves, there is no rent coming in, and the tenants are typically responsible for more than just kind of the wear and tear. Yard work is a great example. If your tenants neglect yard work, it can have some expensive and very serious ramifications like attracting pests and rodents that can cause all sorts of havoc in the hard-to-see areas of your home, like the crawl space and attic. Then there's multifamily, which generally produces the highest amount of cash flow and also offers a bit more cushion when you're cycling through your tenants, meaning if you stack the leases to expire at different times, someone will always be paying rent, as opposed to a single-family home, a condo, or a townhome, where if there's no tenant, there's no rent. But some of the challenges with multifamily is they're not as available or as plentiful as condos, townhomes, and single-family homes. And there tends to be more to manage with these types of investments. More tenants, more appliances, extra vendors, contractors, it all equals more management. Keep in mind, if the thought of all of these what-ifs in managing a rental property is causing you more stress as opposed to wanting a solid investment plan and foundation, it could be a good sign that investing in real estate might not be the best fit for you. But just know you can always hire a property manager to simplify the management process. All you have to do is factor in the cost of a property manager into your investment property's pro forma. More on that in an upcoming video. Now, the last question, question number 3. Do you plan to flip the home, do a live-in flip, house hack, have long-term tenants, or short-term tenants? Bit of a mouthful there. Well, flipping a home is one of the more riskier investment strategies in real estate. This means it also has the potential for the highest and fastest return on your investment. Greater risk equals the potential for a greater reward. If you're flipping a home for the first time and haven't worked with the, let's say, county before, and or have a team of contractors you haven't ever worked with yet before either, chances are you're going to pay for an amazing education on your first flip that will either have you smarter and excited about the next one, or running as far away from flipping homes as you possibly can. Either way, you're guaranteed to get a great education. Pro tip, when you're running your pro forma on a potential home you're considering flipping, just make sure it also pencils out as a rental. Let's call that Plan B. House hacking. This is when you rent out spaces of your home like your bedrooms, a mother-in-law, an ADU, or a garage in your home with the goal of having the majority, if not all, of your living expenses paid for by tenants. So what you'll most likely lose in some privacy, you'll get to enjoy in minimal, if not totally free living. This is one of my more favorite methods for people starting out as it's the lowest cost of entry and one of the easier investments to manage. Then there are long-term tenants, meaning the more traditional 12-month lease agreement, or short-term leases, meaning hosting tenants through companies like Airbnb, corporate housing, or travel nurses, with an average stay anywhere from a couple of nights to 6 months. So with long-term management, it's typically not too time-consuming, and it's usually very steady with just a few hours of work each month per unit. Whereas with short-term leases, you need a great team that's available to you quickly to help you cycle through tenants and or guests. With short-term, there also tends to be a little bit more of an upfront cost because you have to furnish the entire home, but the cash flow in some cases is double, if not triple, what the long-term average market rental rate is. So if you can get clear on these 3 questions, then you're ready for step 3, which is building your team. And you're now ahead of 75% of the people considering investing in real estate and setting yourself up with a life of more freedom, flexibility, while creating generational wealth. I'm Nick Chambers with Chambers Northwest, a Windermere team. Thanks for watching and happy holidays.